We are not off to a good start this year. Check this out. Popular stocks like Tesla are down 2.2%, Meta down 6%, Palantir down 15%. The fear index is not looking good and investors are looking scared. So let's see how we've done so far this year, because remember, on average, the stock market is supposed to return anywhere between 7 to 10% per year. But so far, we are just 2 months into the year and the stock market has already lost 9%, which means we've lost an entire year's worth of investing progress in just the first 2 months. So the reason I wanted to make this video is to speak to the Andrei of 2014 when I first started investing. I put in all my money I had at the time, which was $30,000. Took me a few years to get to that point, and I put it all into index funds, the classic Warren Buffett strategy. After a year, I made $3,000. I felt really happy about that. I was excited, I was making money, and then the next year, my portfolio dropped below what I had initially invested. And instead of thinking about it like, this is awesome, stocks are on a discount, I should be buying more, I let it affect my mood. I was sad, I was depressed, and I didn't like investing after that point. And I also imagine that right now, there's probably quite a few people feeling the same way that I did when I first started. Now, I'll be honest and say that I have not invested in the markets long enough to give you any kind of financial advice because I have no idea where the market is going to go in the short term, and I've also never invested during a recession other than maybe 2020, but that doesn't really count because it was a different circumstance, because the last time we had something truly scary happen was in 2008 when the market dropped 37%, but we haven't seen that since then. So instead, in today's video, I want to explain why it seems like the sky is falling, because if we understand why, hopefully we can continue staying the course, and I'll also explain why I've stopped buying individual stocks. I promise it's not what you think. I didn't go turbo. You went turbo? Turbo's supposed to be Kevin because he sold all of his stocks. I love Kevin, no shade on him, he's awesome. With that said, this is gonna be a good one. I'm excited, let's get into it. Hi, my name is Andrei Jikh, hope you're doing well, come for the finance, and stay for the stonks. So let's just get right into it. There's 2 simple reasons why our investments are going down this year, and they are the border crisis and interest rates, and here's exactly how. Whenever interest rates go up and stocks go down, the reason is because one of the ways that stocks are valued is based on how much we think those companies are going to make in the future, their future cash flow. So for example, whenever Elon Musk talks about robo-taxis, which is supposed to be a $38.6 billion industry by 2030, analysts will add a portion of that value to Tesla's because they assume Tesla will control a portion of that market. But when interest rates go up, their future cash flow is worth less, which means in the present time, so should their value. Here's an example. Let's imagine this random company is worth $100, right? That's what it's trading at. And let's assume that interest rates, just for easy math, are at 10%. So the net present value of this company is actually $90.90. And here's the formula I used to get there. I know it seems complicated, but it really isn't. All I'm taking is the cash flow at the present time, $100, and dividing it by 1 plus the discount rate. That's the interest rate, which is 10%. Move your decimal over 2 to the left to get 0.1. 1 plus 0.1 is 1.1 to the power of 1, which is still 1.1. So it's 100 divided by 1.1 to get $90.90. What does that mean, right? It means that $90.90 today is worth the same as $100 is 1 year from now. Now, here's how we can take this same assumption and all else being equal about a company, if interest rates go up and the Fed increases it to say 20%, here's what would happen to the stock's value. So same formula, $100 divided by 1 plus the rate, which is 20%. Move it over 2 to the left, that's 0.2. So that's 1.2. $100 divided by 1.2 is $83.33. So the actual price went down because now I need to invest less money to get to that same $100 a year from now because that's the opportunity cost. In simple words, it means $1 today is worth more than $1 tomorrow, assuming again, all else being equal about a company other than a fluctuating interest rate. So now let me give you a very specific example of how this has happened in the real world with the stock market and what happened to the price. Here's a perfect example directly from the history books. Full credit to Andy Kern for the research. Now, between the years 1964 to 1981, the US GDP went from 670 all the way up to 3,124. The economy 4.6x'd. We were printing tendies left and right, so you would imagine then that the stock market probably also did well, because if the economy made money, then companies made money, therefore investors made money. But that's not what happened. Instead, in 1964, the S&P 500 started at 700, and by 1981, the S&P 500 started at only 418. How is it possible that the stock market went down when the US GDP quadrupled? It's because of interest rates. Interest rates went up from 3.5% in 1964 all the way to 13.8%. That is a massive increase, and that is how interest rates are able to compress those stock values based on that NPV formula I just explained. And that is exactly what investors are anticipating right now. Wait a minute, if the present value of stocks is as expensive as it is thanks to the federal fund rate being 0%, then in the future, when interest rates go up, their present value should be lower because we should be using a higher discount rate. Now this is true back in 1999, if you remember, because I sure don't, when guys like Warren Buffett and John Bogle, the legendary investor who created index funds and Vanguard, they both said that they didn't think the stock market would do as well in the next few decades. And the reason they thought that is because they understood interest rate relationships to the stock market. When rates are low, market goes up. When rates are high, market goes down. And at that time, they noticed that rates were relatively low, which means that going forward, we can't really use interest rates to stimulate the market because they were already near zero, and you can't really go lower than zero. That's also why bond prices are inversely correlated to their yield, because if there's a bond out there right now that's paying us 2%, and then interest rates go up to 4%, well then people stop buying the 2% bond and its price falls. But at some point, if bond yields hit a certain point, like 7%, let's say, then investors start to buy more bonds and they go with the safer route because they would rather make a guaranteed 7% return on their money than a maybe something in the stock market. Because remember, a bond yield is guaranteed returns and the stock market does not guarantee a return at all. That is how, when the stock market is not doing so good, the bond market is. And it's also how the more speculative assets are selling off first. I hope all of that makes sense from a basic point of view, but valuing stocks is a lot more complicated than I just explained. But if you want to look at the macroeconomic indicators, which is just fancy word for really big world things, then interest rates are some of the biggest. Now, the second thing that's affecting markets so much right now is global conflict, which is what happens to stocks when Vladimir Putin calls you. Can you hear me now?
Yes, I can hear you now, Andrei. All the time. Everywhere.
Those Ruskies. It's okay, I can make fun. I was actually born in the Soviet Union, and fun fact, my middle name is Vladimir. I'm a cookie-cutter Russian spy. I'm a double agent, though. So now the real question really is, how well does the stock market do during times of conflict? Because my understanding was, and maybe you feel this too, is that conflict has always been profitable for countries. And maybe you've also heard that countries like to do this from time to time to make some extra money, so it makes sense that the stock market would go up. And the answer is yes and no, and the more nuanced answer is
sometimes may be good, sometimes may be.
Now in 1810, Nathan Rothschild once said to buy on the sound of cannons and sell on the sound of trumpets. And what he's saying is, whenever there's a rumor of a conflict, that's when it's a good time to buy into the stock market because that's when people are scared the most. And that's exactly what's happening right now. People are scared the most because we don't know what's gonna happen, so stocks are down. Now this is actually backed up by the Swiss Finance Institute, which looked at all the periods of conflict to see what happens to stocks, and they confirmed this. The only other exception that I was able to find is that if that conflict breaks out unexpectedly, that's when the market reacts negatively. So I found some data to actually back all of this up, and here's what I found. So there's two types of conflicts. There's long-term conflicts like WAR, which I don't know if I'm allowed to say here on YouTube, and then there's short-term conflicts like an unexpected event. Now the market reacts differently to each one. So they looked at the whole stock market with regards to how it performed, inflation, and interest rates, and here's how the market did during long-term conflicts. Large cap stocks, like the ones you'd find from the S&P 500 index, returned an average of 11.4%, which is better than the expected return, but not as good as the small companies did, or small caps, like the ones you'd find from the Russell 2000 index, which have a $2 billion market cap or less, and they averaged a return of 13.8%, but they also had more volatility, which means, yes, you might have made more money, but that's only if you didn't have a heart attack and sell everything. Then, during that first world conflict in 1914, the Dow Jones returned a negative 30%. So it fell pretty substantially, but that's because they closed the stock market for the entire year. But then when they reopened it in 1915, the Dow Jones went up by 88%, which was the highest ever on record. Then, during that second world conflict between 1939 to 1945, the Dow Jones went up by 50%, which is more than the expected 7% per year average. Now, all of this to say is that long-term conflict actually decreases market volatility. There's usually higher market returns, but because of the increased government spending, inflation has also averaged 4.4%, which is higher than the usual. The stocks that did the best during this time period are the more defensive stocks from the utilities, healthcare, and consumer staples sector. So from my portfolio, those are dividend stocks like Philip Morris and Johnson & Johnson and Coca-Cola. Boring, slow and steady blue chip stocks that pay dividends, have a positive cash flow, those typically did the best during long-term conflicts. Now let's talk about short-term conflicts, which are unexpected events that happen randomly and we couldn't predict them happening because, again, they happen sporadically. That's when markets react more negatively. Out of 21 shock events dating as far back as Pearl Harbor in 1941, the one-day market drop, meaning that first day that something tragic happens, the stock market dropped by 1.2%. Now, during that whole conflict happening, the whole market lost an average of 5%, and it took us an average of 22 days to get to the bottom and an average 47 days to recover from it. So on average, long-term expected conflicts are overall good for the markets, and short-term unexpected conflicts are bad for the markets, but we recover from them pretty quickly. Unfortunately, outside of making money, all of it is bad because it's all tragic, but I'm just purely talking about a stock market historical return. So now let's talk about why I've stopped buying individual stocks. I stopped buying individual stocks because I don't have the time, the patience, or the courage to hope that my one stock pick is gonna outperform everything else. Because we live in a world of clickbait and headlines get scarier and scarier every single day, I just don't need that kind of stress in my life, so I just buy this one stock, VTI or VOO, and I just let it ride. So no surprise there. But when it comes to crypto falling, remember, that's the risky stuff. And the risky stuff trends closely with the stock market. So if the market is falling, so are crypto prices. And again, that's just how it works. But whenever we get a global conflict, especially the further on we get through history, the stock market reacts less and less severely. For example, when the Rona happened, that was bad. But then we got the variants, and the market didn't fall as bad because we've been through it before. It's the same rerun of the same movie that we've seen before, so the market doesn't react as much. And that's especially true for global conflicts too. Secondly, we live in a completely different era than we've ever lived through before, where the central bank has the power to do anything and everything to step in and make sure that we don't crash. And I know this might seem crazy to say, but we might live in a time where we'll never see 2008 again, because ever since 2008, we gave them the power to do anything and everything, to pump trillions of dollars into the system to make sure that we don't crash, which is exactly what we did in 2020. And I know that's somewhat of a dangerous assumption to make because the party could stop at any moment, but that's also why I'm not leveraging, I'm not borrowing on margin, and I'm not trading options, because the data shows that the slow and steady way to invest seems to work the best. That rhymed. As always, don't forget to have a wonderful rest of your day. Smash that like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this link right here. Go grab your free stocks, links down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. I'd love to know your thoughts, but in the meantime, I hope this helped explain exactly what's going on. I'll see you soon. Bye-bye.